Hi, I'm John Carvello, president of Stone Oak Capital and Divestopedia. This is our masterclass on selling a mid-market business. In this class, we are talking about valuations. As always, I'm joined by my peer of world-class investment banking experts, Michael Carter, managing partner at Carter, Morse and Goodrich in Southport, Connecticut. Simon Davies, managing director at Spectrum Corporate Finance in the UK. And Bill Snow, managing director at Jordan, Knopf and Company in Chicago, Illinois. Michael, when you assess the potential value of your client's business, what valuation methods are you using?
Generally use several. One is discounted net flow. That's basically doing some projections and discounting them back. That's assuming that we can project a company 5 years. I'd say most of our companies have a real struggle projecting 1 year, so it's a little bit of an academic discussion, but it's a good tool to use because buyers often use it. The other is comparable M&A transactions. Hard to find comparable ones, but we do the best we can finding comparable M&A transactions. Third would be looking at public companies. Those public companies very often are very different than our client, but at the end of the day, we'll use that as well. And then lastly, we'll interview a number of private equity firms that have made investments in the space and get their I'll say, real world feedback. So those would be the four methodologies that we use.
That's really interesting. Simon, are you using similar methodologies? And also, do you consider what I call a leverage buyout analysis and just looking at how a deal can be financed in terms of working backwards to a valuation?
That's an interesting point. I think there's 2 points there for us. For valuation is not the same as what someone can afford to pay for it, which is what we would use a leverage buyout to work out whether they're getting the right returns. But certainly we would look at the valuation of a business based more on its earnings stream, its EBITDA, and applying a multiple to that based on the quality of those earnings. So if a business has strong recurring revenues, it might be on a double-digit multiple. I'm selling one at the moment in the IT space that's on a 13 times multiple, and it's got 90% recurring revenues, more akin to a subscription model. So we would apply that against an EBITDA. Question that will be later is what EBITDA level are you trying to put that on? Is it a run rate or a pro forma? But I'll leave that for later. And to assess the right level of multiple, similarly to what Michael's just described, we would look at comparable transactions. As you say, it's always difficult trying to find the exact comparison, but you take an average, you remove some of the outliers, and you would come up with a number that you looked about right. We'd also look at quoted companies and see what they're trading at on the stock market. Again, we'd apply a discount for marketability of shares. For our private company that would be seen as less marketable. But on that basis, we'd come up with a range of values. And let's face it, the valuation is important to set the expectations of the business owner and also to set our fees as we've described before. It's then the market that really drives the valuation of that business, and it's about presenting the business to the market and understanding what they're prepared to pay for it.
That's a really great point. Bill, are you using similar valuations when you're kind of setting that expectation or the initial onset valuation for your clients?
Well, we are. Valuation, I'm sure, as these guys know, actually is a very complicated mathematical formula that largely depends upon what side I'm representing. I hope the joke works. We do very similar. We look at the trading comps, transaction, discounted cash flow, and leverage buyout, and we will take a weighted average of all four of those and come up with a range that we share with our client, obviously, or our prospect at that point. Obviously, we don't share that with potential buyers. We call that the football field because we take a weighted average of those four. And then depending on the situation, we might say, you know what, it might look like we're really should look at what the trading comps are because there's a lot of action in your industry, or maybe it's the leveraged buyout, which is, for me, one of the main ones. And I know maybe I'm skipping ahead here, but for the LBO, we like that because that shows how much in a traditional sense, a private equity firm can afford to pay for business, putting on a certain amount of debt, maybe some mezzanine financing as well. And then we run all those calculations, some reasonable growth on the business, and then an exit. And what we're looking for is an equity return that starts with a 2. As we say, we want to see 20%. We want to see the banks getting whatever the senior is getting, and then the mezzanine is usually in the mid-teens. And so as long as we're seeing those numbers, we can tell the business owner, here's probably the maximum. Here's how a buyer would finance it. So that does provide us with a very good metric in terms of what a business is worth, and is that going to be acceptable to the owner if we do go to market with the business.
Yeah, you made a great point there that you don't necessarily share the valuation with your, with the market. You let the market decide, but you do use that valuation analysis to set the expectation. Mike,
correct.
Add something there?
Yeah, there's two things. One, I think it's interesting about your viewership. When we set those valuations, we usually add a slide that shows why this company may go sell for below, let's say, the averages, and why they would sell above the averages. And so there's a qualitative aspect of every company that drives valuation, either below the average or above the average. Obviously, 50% of the transactions are falling below the average. So giving them the average is an interesting data point, but we want them to understand which qualities of theirs will drive their valuation up or down. The second thing I would just add is there's a company called GF Data that puts out numbers. I don't know if the other fellows use it, but those numbers are generated by private equity firms on a confidential basis reporting to GF Data. And we find that is very often far more real world than some of the other databases where the reporting is still totally up to the company reporting it, and do they count an earn out? How do they count an earn out? All those sorts of things. So that's a really interesting database that we feel provides a very real world valuation for the lower middle market.
Yeah, great points.